inflation's tilting towards deflation, and the Fed's there'll be the major consensus out there. So, well, they can't ease with the ease they have in the past because of the inflation they created last time. So to me, that to me is the bearish scenario that markets are starting to price for. It's pricing for 50 basis points actually by December, we're pricing for 4.5%, and rates are going to go up above 5% in next week or 2 weeks. And to me, that's just not going to happen until markets force them to. It's the new world that people who've been buying dips in the stock market forever are not accustomed to yet, I don't think.
Mike McGlone, a senior commodities specialist at Bloomberg, has warned of an upcoming financial crisis that could rival the Great Depression. He explains that the current situation in global markets resembles the one that preceded the decade-long recession of 1929 to 1939, but it may be even worse. McGlone believes that the Fed will only pivot when the market forces them to do so, and the S&P 500 dropping at a higher velocity is likely to be the number one thing to make them pivot. He predicts that the S&P 500 will tilt back down at some point, as it has been hovering around the 4,000 level up or down 200 points. Despite recent data on PPI and retail sales, McGlone believes that the Fed is unlikely to ease until it doesn't. In terms of crude oil and gold, McGlone notes that crude oil is going towards $40 as deflation in fossil fuels encourages inflation in gold.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
I think the only thing that's going to stop them from raising, they're at 92% that they go 25 on the May 3rd meeting, is a pretty sharp correction in the stock market. I still think that's the main problem that people are not figuring out yet. Even the debt crisis might not get resolved until the stock market makes it get resolved. It's just how these things are right now. So I got to meet with Dave Alteg of the Atlanta Fed last week, and he, I think he was surprised that when I told him, do you realize that the producer price index, it's only been around 75 years, it's falling at the fastest pace in the history of that index? And he kind of like gave me a ham. Now, he was very good. I really thought he was nuanced in the meeting, but he did point out they thought they handled this banking crisis well. He didn't say it, but my implication I get from is, because the stock market and the markets did okay with the response. So they didn't do much. It was the Treasury that did it. But the key things I'm pointing out right now is I have to warn our VIS listeners, need a little bit of a disclaimer, because my job is just to be a trader. I mean, I used to sit in those phones. I was a trader, and I spent my whole time trying to help people mitigate risk and make money. We didn't have a view about anything except to try to make money. And my view right now is I'm bearish almost everything. Bitcoin, Ethereum, stock market, except for long bonds and gold. And I have to say why, because same narrative. We bounced to really good levels. And the sense I'm getting in cryptos and doing all my research is the worst is over. And I look at that as a trader. When you've got money on, you sense everybody thinks the worst is over, yet there's a significant fundamental reasons for the worst not to be over. We haven't even started the recession. The Fed's still tightening, and cryptos are still, they've bounced. Then you want to structure positions accordingly. So I think this 30,000 level in Bitcoin, 22,000 level in Ethereum are pretty serious. And when I can say things like fact that hedge fund positions, managed money net positions in bonds, 10s, and 5-year futures, this was my brethren. This is why I started the business. Shortest ever. Yes. And when you can say that, and there's only one case and example that was close, was 2018. That was right around bond yields. 10 years peaked around 3% and then dropped to next to zero. I look at that and was like, in that environment, you want to be selling stock market, buying treasuries, buying whatever they're short. I'm glad you knew that. And buying things like gold. And you don't want to be long any risk assets. Now, yes, it could be wrong in the short term, maybe just hedging. But this is an example of how I think technology has changed. I remember in the mornings, when in the trading pits, first thing you'd go in the morning is to get the sheets. And you check out what positions were and what open interest did and stuff. Now it's all electronic, instantly. Now this data is once a week, but to me, it's just how it's migrating so fast. I see that kind of data, and I see what happened recently in crude oil. It bounced for a good reason. OPEC, it just squeezed the shorts, going back to bear market. Copper, going back to bear market. And the sense I'm getting is most people are saying, I'll bet a dip. I'm like, these are significant bear markets in commodities. You're supposed to sell rallies. And everything is teetering to me on the stock market. And cryptos might be pointing out you're supposed to be doing that short term. Now, yes, you've heard this narrative from me before. It takes a while. I remember 2007 was a really tough year for me. I was trading them. But this is how I see everything at the moment now. And just the key thing I want to mention leaving you with is this. I think we're on the cusp of a significant deflationary cliff, and the only thing that's holding it up is the stock market. It has to stay higher, or things like crude oil is going to just drop to 40. I don't see what stops it other than things I can't predict, like wars.
McGlone delves deeper into the ongoing banking crisis and its underlying causes. He emphasizes the warning signs of inflation that are becoming increasingly evident, yet the Federal Reserve seems to be disregarding these signals while focusing on other factors. Let's proceed with McGlone's discussion.
I think the March bank issues are very much trees in the macro forest. And what was the main reason this happened? Because rates went up so fast and people didn't hedge properly. And the key point is rates are still going up. Yes, they're fixing each tree, but the forest is burning. And I think that's the macro is overwhelming. The fact that the Federal Reserve is still tightening. Yes, they might stop soon, and the rules of long and variable lags are just getting started. And then there's also going to always be opportunities, markets that lag that. So to me, some of that stuff is watch the money that's leaving banks. It's just cannot expect a credit contraction without that. You kind of not expect a pretty significant pressure on the economy when you see that, and particularly the Fed tightening. And the key thing is the foundation for all this is where were risk assets before all this started? Remember, the stock market was one of the most expensive ever in many other measures. So I look at what's happening now as part of that slow moving trend. I see significant deflation in commodities, significant deflation in PPI, all the leading indicators, and the Fed still tightening. And the bank contractions is part of it. Now you look at things, okay, where's that going to matter? Let's look at housing. New homes under construction, peaking from the highest level ever. Data is only 50 years on that one. Home sales, mortgage applications. I mean, this is clearly deflationary trends. And you look at the key thing that my colleague Anna Wong pointed out this morning was ECI and personal consumption expenditures will remain sticky. Those are the main inflation measures the Fed looks at, but that's the problem. They're still focusing on those things. So I look at it that this is things that I pointed out in 2007, and it's worse. Because back then you actually had a stock market that wasn't as lofty compared to 10 years ago. The market still believes that the stock market trend is up. I think that's due for decoupling. The Fed stated it. Chairman David Attic said, he said, we expect unemployment to go up and inflation go down. Now, it's virtually impossible to have unemployment trial from this level without a recession. It's just the way history's always worked. When you have the lowest unemployment in 60 years, it always happened a few times. And then it's that sensation I think people are forgetting. And of course, he fully says we're on track for a soft landing. Priced in, boom, great. Everybody's priced in a soft landing. Where's your optionality? That we don't get a soft landing, that we get a normal reciprocal cycle from the biggest pump in liquidity that's dumping ever. Now, Bitcoin was such a big part of that. Cryptos were such a big part. And we both agree 22,000, 23,000 cryptos is ridiculous. A lot of those have to just get purged. Ethereum probably do okay. Bitcoin should be the best one. But here's a fact. On a one-year basis, gold's up about 5%. Stock market's down about 5%. Bitcoin's down about 30%. Commodities down about 30%, 20%. That's a trend. And I think that's going to continue. But here's the key inflection point. Once we wake up one morning, it's going to happen. You see, if I'm wrong, but at some point we have to see the stock market breaks. We have to see how Bitcoin responds to it. And I think the key thing that might be happening is Bitcoin can lead that. Cryptos can lead that because they're the most speculative assets in the world. They play and trade on weekends. A lot of times they just lead. Then some point break down. So it was nice to see that the bank indices break down and Bitcoin break up. But now we're at that stage. I just get this every place I go, like NFT, Miami NFTs. Oh, it's an NFT winter. I'm like, and you go to Bitcoin cryptos. Oh, it's a crypto winter. I'm like, no, it's an everything winter that's bounced. This is what the key thing I need to point out to people who only trade Bitcoin, and then there's people who never trade Bitcoin and trade equities. Is everything has been together with the Fed, and that's the key thing. The Fed is still, they're fighting the Fed if you're too bullish here.
Industry experts, including Bloomberg Intelligence's senior commodity strategist, Mike McGlone, have commented on the current outlook in the digital currency ecosystem. According to McGlone, Bitcoin and Ethereum have hit key resistance levels at pivot points of $30,000 and $2,000, respectively. McGlone believes that these revolutionary technologies and assets may run into a wall of resistance at these levels. In April, Bitcoin and Ethereum soared to over an 11-month high, amidst growing positive ecosystem fundamentals. While the Bitcoin ecosystem did not record many updates, the Ethereum ecosystem was filled with impressive news that generally helped elevate the status and outlook of the blockchain. For instance, the long-awaited Chapella upgrade went live earlier this month, enabling withdrawals from millions of stake Ethereum coins locked since December 2020. The crucial upgrade is part of the targeted track to aid the rebranding of Ethereum as a proof-of-stake platform, and it is now a major attractive investment option for institutional and retail investors. However, Coinbase filed a suit against the Securities and Exchange Commission, asking the regulator to publicly share its answer to a month-old petition on whether it would allow the crypto industry to be regulated using existing SEC frameworks. The SEC did not offer a specific public response to Coinbase's petition, but in recent months, it has aggressively ramped up enforcement actions and warnings against crypto exchanges, including Coinbase. The fight between the SEC and cryptocurrencies is no longer one-sided as various crypto enthusiasts are rising to the call and pushing back aggressively. What do you think of Mike McGlone's macro outlook on the financial market? Let us know in the comments section below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.